Welcome to part 5 of our discussion of money, banks, and monetary policy. In this, we start off by a discussion of why is monetary policy needed, and it really relates back to the last lesson we learned about the money multiplier, what banks choose to do with the money that's deposited. Now, we know that the money multiplier is 1 divided by the required reserve ratio, but banks can choose to hold more money than just the legal minimum, right? Banks can hold excess reserves. Well, during a recession, you would expect banks to be more likely to hold excess reserves, right? So banks will be more likely to contract the money supply by being more restrictive in lending funds. It only makes sense. If you're in a recession, a bank should be a little more skeptical that they're going to get paid back on their loan because businesses are struggling. But during an expansion, banks will see that everything's going very well. They might be more likely to expand the money supply by keeping their reserves as low as possible. So the amount the banks keep in excess reserves could either expand or contract the money supply, and that can expand or contract the economy as well. But unfortunately, what banks are doing is during good times they would expand the money supply, which expands the economy even more, and there's actually the potential then for inflation. But during bad times, banks could contract the money supply, which could contract the economy even more. So what banks do, and they're not trying to do anything here to hurt the economy, but just because they're trying to make money and they're making logical decisions with what to do with their loans. The decisions they make, though, while they are logical, can actually hurt the economy. So if you have monetary policy, if you have a Federal Reserve Board that looks after the money supply a bit, they can help prevent the banks from exacerbating economic problems by some monetary policies. So what does the Federal Reserve do? Well, one job is indeed to regulate the banks. Want to prevent bank runs, keep banks from operating. FDIC deposit insurance. If you ever see FDIC in a bank, that's deposit insurance. That's part of what the Federal Reserve does. Your deposits are insured up to $250,000. There's also supervision of banks to make sure banks aren't taking unnecessary risks or try to help prevent banks from taking unnecessary risks, along with the reserve requirements, which we see at 10%. So deposit insurance, if you have money in a bank, you're not going to lose it, even if the bank goes bankrupt. That's FDIC. I'm guessing most of you are familiar with that term, the acronym FDIC. The big thing that this does is it limits the need for any individual to rush off to a bank if you hear bad news about a bank's finances, right? If you heard a rumor that the bank down the street's going to go out of business and you have money there, you don't have to be in a panic that you are going to lose your money and then rush to the bank to withdraw it. The good news about this type of policy, though, is bank runs can be self-fulfilling. If people think a bank is going to fail and then everybody goes to withdraw their money, well, then the bank will fail. It's a self-fulfilling prophecy. The fact that there is insurance, you're going to get paid even if the bank went out of business. You don't have to rush to withdraw your money from a bank. So that helps prevent bank runs. For bank supervision, the government can conduct periodic examinations. There's also some laws that could limit the types of investments that banks can make. And we talked about reserve requirements. It's the minimum amount in cash that a bank has to hold from its deposits. The U.S., it's 10%.